Hey everybody, thanks for joining me today. Today I'm doing a stock analysis on a company called Archer Daniels Midland Company, ticker symbol ADM. The stock was down almost 25% in one single day this past week. Stock is down almost 40% over the past year. So I think this is a good opportunity to dig into the company and figure out what the fair value of the stock is right now. Similar to other videos I do, the stock analysis video on ADM is split into 4 different parts. The first one is a business overview. What does this company do? What do they have any competitive advantages? Second part is a financial overview. What do their 10 years worth of financials look like in different metrics on the P&L, balance sheet, and cash flow? The third one is stock valuation. We're going to look at 4 different valuation methods to determine what the fair value of the stock is. And fourth was a return on investment that we would expect to get based on assumptions that we make in this video. So let's jump into the business overview now. So the company is split into 4 different business segments. So you have the agricultural services and oil seeds, you have carbohydrate solutions, you have nutrition, and then you have other. The agricultural service and oil seeds is a segment which manages the global supply chain of agricultural raw materials, including origination, merchandising, transportation, and processing. It plays a crucial role in producing oil seeds-based products for various industries with notable equity interests in key ventures worldwide. The carbohydrate solutions business engages in corn and wheat, wet and dry milling. This segment produces a diverse range of products for the food and beverage industry, including sweeteners, starches, alcohol, and animal feed ingredients. The nutrition segment services diverse markets such as food, beverages, nutritional supplements, and animal feed. The nutrition segment manufactures and distributes a wide range of ingredients and solutions, including plant-based proteins. Archer's business model is extremely diverse across different industries and provides a very wide moat for the company. This is a business that other competitors would have a very difficult time duplicating. Here are some different stats on Archer. So they have 750 facilities, 64 innovation centers. They service over 200 countries. They have 300 food and feed processing locations, 440 crop procurement locations, 42,000 employees. With the recent fallback on stock price, the market cap is currently around $30 billion. The company was founded back in 1902. The company has been traded on the New York Stock Exchange since 1924. Over the past couple of decades, the company has been very aggressive in acquisitions and divestitures. As you can see on the screen, the company has acquired or gone into joint ventures on a multitude of different companies. Just on this screen, you can see over 30 different acquisitions or joint ventures. The company has also spun off several of its key businesses, including fertilizer, lactic acid, chocolate, cocoa, Brazil sugar, and much more. The company reached over $100 billion in revenue in 2022. The company's AG services and oilseeds business segment has seen substantial growth over the last couple of years. In fact, if you go back to 2021, this business segment increased 84% of its operating profit. And a big reason why the company has seen substantial growth over the last couple of years. This business segment alone produces about 60 products used in food, animal feed, renewable fuels, and industrial products. They have processing facilities in 15 different countries and procurement storage locations in 23 different countries. So why in the world did the stock drop about 25% in one single day in this past week? Well, ADM shares plunged because their CFO was forced to leave amid accounting probe by the SEC. These recent allegations led to an investigation and him being placed on administrative leave for certain practices and procedures regarding the nutrition segment of their business. This ultimately led to ADM delaying their Q4 earnings and withdrawing guidance for the nutrition unit. This is a major deal for the company and investors of the company. This also places scrutiny on the financials of the company. However, it is important to note that the nutrition segment of the business only represents about 7% of the total revenue of the company. So, though the company did name an interim CFO, and I'm sure they will go through the financials of the nutrition segment of their business to make sure that is accurate, I would not be completely surprised if they have some revised numbers that come out into the future, but we don't know what those may or may not be. The good news is because it is only 7% of their revenue, it shouldn't make a material impact on the P&L, or at least the likelihood should have a small impact. But at this time, we're going to have to sit and wait until the company gets through their due diligence. Another reason why the stock has fallen, even in the past week or so, is several analysts cut their price targets for the company, which pushed down the shares even further. It is always a bad look for a company when they delay earnings. So all in all, there really was a multitude of reasons which pushed the stock price down. And no one really knows where the bottom will fall. There can only really be speculation until the company comes out with their Q4 earnings. So if you're wondering how the business segment's profitability is split out between the different business segments, including the nutrition segment, this is what it looks like for Q3 2023. So the company's total operating profit was roughly $1.4 billion. The AG Services and Oilseeds business segment provided $848 million. The Carbohydrate Solutions business provided $460 million. The Nutrition Services provided $138 million, and the other businesses provided $46 million. So the huge issue around the SEC probe around the nutrition business segment is only $138 million out of $1.4 billion. So it's certainly less than 10% of the total operating profit of the business. The company is a very good allocator of money. We saw the different companies they acquired or went into joint ventures with earlier in this video, but you can see on the screen that through the first 3 quarters of 2023, they did put $1.1 billion into CapEx. They gave back to the shareholders about $0.7 billion worth of dividends. And they also did about $1.1 billion of share repurchases. And the company is expected to continue to spend another $400 million in CapEx in the fourth quarter. Next, let's take a look at the financial history of Archer Daniels. So we're going to do a 10-year review of the company, and we're going to be looking at the big 5. So we'll be looking at sales per share growth, earnings per share growth, free cash flow per share growth, book value per share growth, return on invested capital. I like to look at a per share basis because it factors in all share issuances and share buybacks of the company. We're also going to be looking at different balance sheet metrics as well to see how well they're doing on the balance sheet front. So on your screen now, you can see their enterprise value has slightly grown from 2013 to now. It's grown from about $31 billion in 2013 to $36 billion here today. But if we went back just about a year or so, at the end of 2022, the company was worth about $60 billion of enterprise value. So the company's stock, market cap, enterprise value has fallen quite a bit. Now, if we look at their sales per share, that has grown per year about 3% over the last 10 years. Earnings per share growth has grown 14% per year. Free cash flow has actually fallen negative 18% per year. Book value per share has increased about 5% per year. The return on invested capital has averaged roughly 7%. So looking at these numbers, they are clearly all over the place. From 2016 to 2019, and even in 2020, the company had negative free cash flow. However, they had earnings and growing earnings during that same time period. So the cash flow statement adjusts all non-cash related items. So for example, depreciation will fall onto the income statement as an expense, while depreciation is tied to a fixed asset that was already spent money on in a previous period. So technically, the outflow of money did not occur in that period, but the company is logging expense for that fixed asset. So what it's telling me during those 5 years, though the earnings per share was growing and was positive, the actual outflow of cash from the business was negative over those 5 years. But the AG Services and Oilseeds segment business really started taking off in 2021, and we saw massive growth, especially on the top line and even on the bottom line of the business. Next, let's take a look at some balance sheet metrics. And first off, we'll take a look at debt. And one of the things I like to look at is how long it would take to pay off all long-term debt based on free cash flow. Now, the average for the company has been roughly 2.5 over the last 10 years. However, it's important to note that 5 of those years, they had negative free cash flow. So it's kind of skewing these numbers. Currently, their free cash flow has significantly dropped over the past 12 months. So according to my model here, it's saying it's going to take 17 years to pay off all their long-term debt. So that looks very concerning on the surface. However, another metric I like to look at is debt to equity. And for me, I like to see it under 100%. And currently it's sitting at 37%, which is really impressive. And it tells me that the company has very low debt versus their equity, which is fantastic. In addition to that, the company's current ratio is sitting at 1.7. So that tells me they have plenty of working capital. So they have plenty of current assets to cover any current liabilities that they have. So overall, I'd actually say their balance sheet is in very, very good order and looks very solid. So I really don't have anything to worry about when I'm looking at these numbers. Next, let's take a look at what the market has been willing to pay on a multiple basis for the company over the last 10 years, and also where have the margins kind of trended. So as far as a PE goes, the market has on average been willing to pay a 16 multiple for the company over the last 10 years. Currently, it's at a 7, so it's almost half of where it's been at historically. What's even more interesting is that gross margins and operating margins have improved over the last 10 years. Gross margins have grown from 4% all the way up to 8%, so doubling over the last 10 years. And their operating income has also doubled, going from 2% in 2013 to 4% here today. So for a $30 billion company, that is really impressive that they've been able to double their margins over the last 10 years. But keep in mind, too, a good portion of their business is tied to commodities. So as prices of commodities go up and down, so will their margins. And the company has seen an uptick, especially on their AG services and oilseeds business over the last 2 years, which has really helped their margins. So here are all those different metrics that we just talked about on one screen here. So overall, their balance sheet looks really, really good. They have very, very low debt. They have quite a bit of equity versus their liabilities, which is fantastic. Plenty of working capital. Their margins are improving. However, the return on invested capital is much less than I'd like to see it for companies that are well established. So even though the return on invested capital for the last 2 years has been 13 and 11% respectively, on average over the last 10 years, the company has only produced 7% of ROIC. And if you're not sure what ROIC is, essentially that is a metric that tells us how well the company is able to take investor money and profits of the business, reinvest in the company, and generate profit. For a business like Archer Daniel, I would like to see them over 10% consistently. But I do have to say their earnings per share growth and even sales per share growth over the last 3 years has been very impressive, with sales growing 16% per year and their earnings per share growth growing 32%. Next up, let's take a look at some valuation models and try to figure out a fair value of the stock. And we do this by looking at 4 different valuation models. So the first one is a margin of safety calculator, looks at earnings per share. The second one is a discounted operating earnings model that looks at operating earnings. Next 2 are actually Phil Town's valuation models. One is a 10 cap that looks at owner's earnings, and the fourth one is payback time, which looks at free cash flow. So first up is the margin of safety calculator. So for this one, I come up with, I would consider a normalized earning per share of the business, try to figure out the growth over the next 5 years, and from there I can get a target buy price. So I think a normalized EPS for the company is about $4.75. Technically, over the last trailing 12 months, they've been roughly around $8 of earnings per share. But I believe the business has seen a lot of tailwinds, which has propped up their earnings per share and I don't think it's necessarily sustainable. I think $4.75 of EPS is more normalized for this business. Based on a 10% growth rate for EPS, that gives me a growth multiplier of 1.6, an EPS multiplier of 7.6. So I come with a target buy price of $51 here today. Next up is my discounted operating earnings model. This one looks at sales of the business, forecasted out over the next several years, then based on forecasted operating margins, come up with operating earnings over the next several years. From there, we get our net present value of future earnings, and then we discount it back to today to get to an intrinsic share price. Based on a multiple of 15 for the company, I come up with an intrinsic share price of $63 for this valuation model. If you are wanting to know how to value companies, I do offer this template along with other templates on my Patreon page. If you're interested, I'll put a link down in the description. Next up is a 10 cap valuation. This one looks at owner's earnings of the business. And essentially, we want to pay 10 times owner's earnings per share of the business. That's where that 10 cap comes from. So I believe a normalized free cash flow for the business is roughly $2 billion. If you look at historical free cash flow, it is up and down over the last 10 years. But from all the research I've done, I believe $2 billion is more of a normalized free cash flow of the business, also based on $700 of tax provisions and 533 million shares outstanding. I come with an owner's earnings per share of roughly $5. Multiply that by 10 with rounding, I come to a 10 cap valuation of $51 here today. Next up is a payback time calculator. This one strictly looks at free cash flow of the business, projects it out over the next 10 years, and basically we want to get our money back in 8 years or less. If we can do that, it will signify, or hopefully that signifies based on our assumptions, that is trading at a margin of safety and a good price right now. So I'm still using that $2 billion of free cash flow we talked about in the 10 cap valuation model. I believe free cash flow growth should be around 10% per year, which is similar to the EPS growth that we already talked about. Based on these assumptions, I would get my money back in 9 years. So that is slightly above the 8 years I would like to get my money back in with this stock or any type of stock. But at 9 years, that tells me that the price currently is not far off from a buy price. So let's summarize all 4 of those valuation models we just talked about. So the first one is a discounted operating earnings model, which suggests the fair value is $63 here today with a 30% margin of safety. That gives me a buy price of $44. The payback time model suggests the buy price is at $47. The 10 cap model suggests $51, and the margin of safety calculator suggests $51. The stop price today is $52. So according to all 4 of these models, the buy price is very close. So now let's look at return on investment from the stock based on the assumptions I just mentioned. So to summarize those assumptions, I believe the sales growth will be around 4% per year over the next several years. Operating income will be around 4% per year. I think an exit multiple will be around a 15 for this company. Based on these assumptions, a share price of $51 would suggest a return on investment of roughly 15%. Whereas if the stock price were to fall to $41, I believe I would get a 20% return on investment per year over the next several years. This does not include the dividend that the company is paying. Currently, it's $1.75 per share annually, which comes to 3.4% for the current yield. However, I must stress we don't know what Q4 earnings are going to be. Like I said earlier, they have been suspended because the CFO was put on administrative leave by the company because of a probe by the SEC around the nutrition business segment and potentially not following GAAP, which is a major issue. Luckily, that business segment is only 7% of the total revenue of the business. So after the company does their due diligence and they come out with their Q4 earnings, And if there's not much change to 2023's numbers as a whole, and the company can reaffirm guidance, we may see an uptick in the stock price. But at this time, it's kind of a hold and wait. But I would be curious from you guys, do you own Archer Daniels right now? And do you think this is a good buying opportunity? Thanks again, everybody, for staying all the way to the end of this video on Archer Daniels. If you're curious on how to value companies, which is a critical part of evaluating companies, I do offer valuation templates on my Patreon. You also get access to my Discord channel. You get access to my Patreon-only posts. And I do provide my valuation workbook for each of the videos that I put on YouTube. So you can always go back and look at those in the future. I also provide commentary if I'm interested in buying the company or not, and I do share my stock picks on Patreon as well, along with my stock portfolio, and provide all returns in my portfolio versus S&P 500. For example, in 2023, my portfolio returned over 40% for the year. So if you're interested in my Patreon, I'll put a link down in the description. Thank you, everybody, for watching. I really appreciate it. I'll catch you on the other side. Take care, and God bless.